Welcome back to XRP On Moon, the channel where we break down the most controversial, hyped, and misunderstood stories in the XRP ecosystem and separate emotion from reality. If you've been watching XRP lately, you've probably seen shocking claims circulating everywhere. Headlines talking about a 99% volume collapse, whispers of liquidity disappearing overnight, and theories suggesting something massive is unfolding behind the scenes. But the real question is, what is actually happening, and what is just noise designed to create fear? Before we dive in, imagine this for a second. A top global crypto asset, traded across hundreds of exchanges, suddenly appears to show a near-total collapse in trading volume. Not a small dip, not a normal correction, but a dramatic, almost unbelievable drop that sparks panic across social media. Traders start asking, is XRP losing interest? Are institutions pulling out? Or is something deeper and more technical happening under the surface that most retail investors simply don't understand? Because here's the truth that many people miss. Volume in crypto is not just a simple number. It is not a pure reflection of demand or adoption. It is a highly fragmented, exchange-dependent metric that can change dramatically based on liquidity shifts, reporting methods, market structure changes, and even the behavior of market makers. So when someone says 99% collapse, the first thing an expert does is not panic, but question the data itself. Now let's step into what could actually be driving these narratives. Over the last few years, the crypto market has undergone massive structural changes. Liquidity is no longer concentrated in just a few major exchanges like it used to be. Instead, it is spread across centralized platforms, decentralized exchanges, internal liquidity pools, and even private institutional channels that are not always visible on public dashboards. This creates a situation where reported volume can look like it is collapsing, when in reality it is simply moving elsewhere. At the same time, market makers play a major role in how volume appears on charts. When volatility decreases or spreads tighten, trading activity can become more efficient, but that efficiency can sometimes reduce visible volume figures. To the average viewer, it looks like activity has vanished, but in reality, the same amount of value may still be flowing, just in a more optimized and less noisy structure. And then there is the psychological layer of the market. XRP, more than many other assets, lives under constant scrutiny. Every spike, every dip, every technical anomaly becomes fuel for speculation. A sudden drop in reported volume quickly transforms into viral content, often exaggerated into extreme claims like 99% collapse, even when the underlying reality is far more complex and less dramatic. But here is where things start to get interesting. Because whether this is a reporting illusion, a liquidity redistribution, or an actual slowdown in speculative trading activity, it raises a deeper question that we will explore in this series. Is XRP truly losing market participation, or is the market quietly shifting into a new phase that most traders are not ready to recognize yet? In the next part, we are going to break down how exchange data can be misleading, how liquidity fragmentation changes the perception of volume, and why what you see on the surface might be completely different from what is actually happening underneath the market. To understand the so-called 99% XRP volume collapse, we need to step away from emotional reactions and focus on something most retail traders never fully examine: how exchange-reported volume actually works behind the scenes. Because what appears on charts is not always a direct reflection of real market activity. In fact, in many cases, it is only a partial snapshot of a much larger and more complex liquidity system. One of the biggest misunderstandings in crypto markets is the assumption that all exchanges report volume in the same way, with equal transparency and equal standards. In reality, each exchange has its own internal structure, liquidity sources, and reporting mechanisms. Some platforms aggregate trades differently, some filter internal matching differently, and others rely heavily on market-making systems that can artificially inflate or compress visible volume depending on conditions. Now imagine this on a global scale. XRP is not traded in a single centralized environment. It exists across dozens of major exchanges, hundreds of smaller platforms, and increasingly in decentralized liquidity pools. When liquidity shifts from one venue to another, the total visible volume can appear to drop sharply, even if the actual economic activity has simply migrated elsewhere. This is one of the key reasons why volume charts can sometimes show dramatic declines that look like collapses, when in reality they are structural redistributions. Another important factor is the rise of off-exchange liquidity. Institutional players often do not execute large orders directly on public order books. Instead, they use OTC desks, private liquidity channels, or internal execution systems designed to minimize slippage and market impact. These trades still represent real XRP movement, but they do not always appear in standard exchange volume metrics. As institutional participation increases, more liquidity quietly exits public visibility, creating the illusion of declining activity. On top of that, we have to consider the role of market makers. In efficient markets, market makers continuously provide buy and sell liquidity to stabilize price action. But when volatility drops or when spreads tighten, their need to aggressively trade decreases. This reduction in rapid back-and-forth transactions can significantly reduce reported volume, even though the underlying market remains active and functional. To an outside observer, this can easily look like demand has disappeared, when in reality, the market has simply become more efficient. There is also a technical reporting issue that often goes unnoticed. Many crypto data aggregators rely on APIs from exchanges, and not all exchanges provide identical levels of detail or accuracy. Some trading activity may be underreported, delayed, or even excluded, depending on how it is categorized. This can further distort the perception of real-time volume, especially when comparing data across multiple platforms. When all of these elements combine, liquidity fragmentation, institutional off-exchange trading, market maker behavior, and reporting inconsistencies, the result can be a chart that looks alarming at first glance. A 99% drop narrative becomes easy to spread because it visually matches fear-based storytelling. But when you break down the structure, the picture becomes far more nuanced. And this leads us to a deeper question. If reported volume is not a perfect mirror of real activity, then what does it actually tell us about XRP's current phase in the market cycle? Is this truly a decline in interest, or are we witnessing a transition from retail-driven speculation to more mature infrastructure-level liquidity movement that is simply less visible? When people hear the phrase volume collapse, the immediate assumption is simple. Interest is fading, traders are leaving, and the asset is losing momentum. But in real market structure, especially for an asset like XRP, quiet periods do not always represent weakness. In many cases, they represent a transition in how liquidity is being formed, moved, and hidden from public view. To understand this, we need to think in terms of market phases rather than isolated numbers. Every major asset goes through cycles of hype-driven retail activity, followed by consolidation, and then periods where liquidity begins shifting into more stable and less visible channels. During these transitions, the surface-level activity can look like it is drying up, while the underlying infrastructure is actually becoming more complex and mature. One of the key drivers of this shift is the behavior of long-term holders and institutional participants. Unlike retail traders, who frequently enter and exit positions based on short-term price movements, larger players tend to accumulate or distribute assets in a more controlled and strategic manner. This type of activity does not generate the same high-frequency volume spikes that show up prominently on exchange charts. Instead, it creates a smoother, slower flow of capital that is often invisible to standard volume tracking tools. At the same time, liquidity does not disappear. It relocates. In crypto markets, liquidity is highly mobile. It can move from centralized exchanges to decentralized platforms, from visible order books to OTC channels, and from public trading environments to internal settlement systems. When this happens, the asset does not necessarily become less active. It simply becomes less transparent in traditional data feeds. This is especially relevant for XRP, which is often discussed in the context of institutional utility and cross-border settlement potential. If even a portion of liquidity begins shifting into systems designed for efficiency rather than speculation, then the visible trading activity on public exchanges naturally decreases. But that decrease does not automatically indicate reduced usage. It may indicate a change in the type of usage. Another important factor is market maturity. In early speculative phases, assets often experience extremely high trading volumes because participants are constantly reacting to price volatility. But as markets mature, trading behavior tends to stabilize. Fewer impulsive trades occur, spreads tighten, and arbitrage opportunities shrink. This results in lower visible volume, but not necessarily lower value transfer. In fact, in many traditional financial markets, lower volatility and lower volume are signs of maturity, not decline. However, perception plays a powerful role here. When traders see declining volume without understanding its context, they often interpret it as a warning signal. This psychological reaction is amplified in crypto markets, where narratives spread faster than data analysis. A simple shift in liquidity structure can quickly become a viral story about collapse, even when the underlying system is functioning normally. So the real question becomes, are we looking at a weakening asset, or are we witnessing a redistribution of liquidity into channels that are not designed to be visible on retail dashboards? And if that is the case, then the quietness might not be a warning sign at all. It could be a sign of evolution in how XRP is being used within the broader financial ecosystem. To truly understand the so-called XRP volume collapse narrative, we need to zoom out and look at something most traders ignore in real time: the repeating structure of market cycles. Because in financial markets, what feels like a breakdown in the moment is often just a familiar phase that has appeared many times before across different assets, different eras, and different levels of adoption. When volume drops significantly, especially after periods of heightened speculation, the instinctive interpretation is negative. Traders assume participation is leaving. But historically, low-volume environments have often appeared not at the beginning of a collapse, but during transitions between accumulation and expansion phases. These are the quiet periods where direction is not obvious, volatility compresses, and most retail participants lose interest because nothing exciting seems to be happening. This is where market psychology becomes critical. Human behavior tends to associate activity with opportunity. High volume feels like opportunity because it creates movement, excitement, and visible price swings. Low volume feels like inactivity, and inactivity is often misinterpreted as decline. But in reality, many of the strongest market moves begin when attention is lowest, not when it is highest. If we look at broader financial history, this pattern repeats consistently. Assets often go through cycles where volatility and volume peak during emotional phases, usually driven by hype, speculation, or fear, and then gradually contract as the market resets. During these contraction phases, liquidity is not necessarily leaving, it is often repositioning. Orders are being placed more patiently, participants are waiting for clearer signals, and large players are building exposure without creating obvious footprints. In the context of XRP, this becomes even more relevant because of its unique market identity. XRP is not just a speculative asset in the eyes of many participants. It is also tied to narratives of institutional usage, cross-border settlement systems, and long-term infrastructure development. Assets that carry this dual identity often behave differently from purely retail-driven tokens. Their quiet phases can be longer, their liquidity distribution more complex, and their visible volume less reflective of actual underlying activity. Another important concept to understand is volatility compression. When markets enter a phase of reduced volatility, trading activity naturally slows down. This is not because interest disappears, but because price stability reduces the need for constant repositioning. Traders are less incentivized to enter and exit repeatedly. Arbitrage opportunities shrink, and short-term speculation declines. The result is lower volume, but also a more stable market structure that can serve as a foundation for future expansion. However, the challenge is perception. During these phases, the lack of visible movement creates space for extreme narratives to emerge. Some interpret it as a precursor to collapse, while others interpret it as a setup for a major expansion. The truth is that the data alone does not tell a complete story. It only reflects the current state of participation, not the intent behind it. This is why experienced market observers rarely focus on volume in isolation. They look at structure, liquidity distribution, and behavioral shifts across time. Because what appears to be a 99% collapse in one dataset can, in reality, be a phase where the market is quietly resetting itself for the next cycle of movement. So the question we are left with is not simply whether XRP volume has dropped. The real question is what kind of phase this represents in the broader cycle. Is it exhaustion, where interest is fading permanently? Or is it compression, where energy is building quietly beneath the surface, waiting for a trigger that most of the market is not currently focused on? When we bring all the pieces together, the 99% XRP volume collapse narrative starts to look very different from the way it appears in headlines. On the surface, it sounds like a dramatic breakdown in market participation, but once you understand liquidity structure, exchange reporting limitations, institutional flow behavior, and market cycle dynamics, the picture becomes far more layered and far less extreme than the initial claim suggests. The most important realization is this: volume is not a direct measure of value, adoption, or long-term strength. It is a reflection of how actively participants are trading within visible markets at a specific moment in time. And in modern crypto ecosystems, a growing portion of real economic activity is no longer fully captured in that visible layer. Liquidity is increasingly distributed across private channels, internal systems, and more efficient settlement mechanisms that do not always generate traditional exchange volume. So when people observe a sharp decline in reported XRP volume, the first mistake is assuming that activity itself has disappeared. In reality, what may have changed is the visibility of that activity. Markets evolve, and as they evolve, they often become less dependent on public order book noise and more dependent on structured, optimized flows of capital. That shift alone can dramatically reshape how volume appears on charts without necessarily indicating any fundamental weakening of the asset. At the same time, it is also important not to swing to the opposite extreme. Lower volume does not automatically mean something bullish is guaranteed, or that a massive move is imminent. Markets are more neutral than narratives suggest. A decline in activity can simply reflect a phase of indecision, redistribution, or waiting behavior among participants. The key is not to attach emotional meaning to the data, but to interpret what type of environment the data is describing. In XRP's case, what we are really seeing, based on structural interpretation rather than headline interpretation, is a transition phase. A phase where speculative intensity has cooled, liquidity has become more fragmented, and participation has shifted away from rapid retail-driven cycles into slower, more complex flows. Whether this ultimately precedes expansion or further consolidation cannot be determined from volume alone. What can be understood, however, is that markets often behave quietly before major structural shifts. Not because something is guaranteed to happen, but because attention, liquidity, and positioning tend to reorganize during low visibility periods. This is why experienced participants rarely rely on dramatic headlines like 99% collapse as standalone truths. Instead, they look at whether the market structure is deteriorating or simply transforming. And this is the core takeaway. The story of XRP volume is not just about numbers on a chart. It is about how modern financial systems distribute liquidity across increasingly complex layers. Once you understand that, the idea of a simple collapse becomes less convincing, and the idea of a structural evolution becomes much more relevant. So instead of asking whether XRP volume has collapsed, the more meaningful question is this: what phase of participation are we actually witnessing right now? And how will the next shift in liquidity reveal itself when the market decides to move again? Because in markets like this, silence is not always absence, and reduced volume is not always decline. Sometimes it is just the market changing the way it speaks. This content is for educational and informational purposes only and should not be considered financial, investment, or trading advice. Cryptocurrency markets are highly volatile and risky. Always do your own research and consult a licensed financial advisor before making any investment decisions.